to Women's Network Australia. This is our special webinar on end of financial year preparations, something that we perhaps approach with dread and trepidation, but we're hoping as a result of our expert support here today with Bronwyn and Dianna that we can take a little bit of the fear and put in a little bit more of the planning, so to make that end of financial year preparation, can we say, enjoyable, but certainly a lot easier than perhaps it has been for us in the past. So for those of you who are coming in as we're rolling along, Mariam, just so you also can see the toggle view at the bottom, the bar where you can change from a full screen view to a gallery view. And you can change that to suit yourselves. We will be sharing a PowerPoint presentation in a moment that you will be able to then increase the size of to see the screen. For those who booked, we will make the recording available to them. And thanks right off the bat to Bronwyn and Dianna for giving up their time in a very busy part of the year for both of them. Just in terms of introductions, I'll introduce Dianna first, who's coming to us from the East Gippsland region, where it's pretty cold, but she's well prepared for it, simply because she has a background in the area in farming, in wheat and sheep farming in the southern Riverina where she grew up, but now living in northeast Victoria on a beautiful property there. Dianna commenced accounting after she left school and became an accountant in a small practice, and then I think probably recognised that many of the small business clients that she would have had at the time, looking at ways to simplify and deal with some of the overwhelm that comes with perhaps some of the compliance requirements that flood us all, including accountants for that matter. So she left mainstream tax and accounting and created Shine at Business to meet the growing unmet need for proactive, holistic business advice and strategic planning. And so that's going to be a great way to move into the broader discussion. So this is not all about numbers, even though I'm sure there will be quite a lot of numbers and discussion around tax. And speaking of tax, Bronwyn Condon, managing partner at Marsh Partners, more than 30 years experience in business development and management accounting, been with Marsh Partners for probably longer than she can count on one hand at this stage, and knows what it's like to run a business. I know that Bronwyn and I have had a lot of discussions about some of the human parts of business running, like staff and recruiting, which are all vital parts of running a successful business as well. So Bronwyn's passion is getting businesses into shape and helping them, obviously not just with their finances and their accounts, but ensuring that they have clarity around their business journey, and then supporting business owners to achieve what they need to meet those goals. So welcome, Dianna and Bronwyn. Welcome to those who are joining us. We're going to hand straight over to Bronwyn. And do you want your slides straight off the bat, Bronwyn, or do you want to have a chat first?
No, go for it.
All right, we'll hand over, and you'll see some slides. So those of you who are joining us, if you toggle down to the bottom, you'll see there's a black bar and a tile that's got 4 squares on it. If you toggle to the bit that, you'll get a full screen view, and when Beck shares the presentation, you'll be able to see that in large view. So hopefully you can all see that now. You can toggle back to the gallery view at any stage. Thanks, Bronwyn. Over to you.
Thank you. So, yeah, it is about tax, but there's other things to consider besides tax as well. So don't fall asleep on me. I know it can be a bit boring, this whole tax thing, but, I'm sure there'll be some takeaways with that. So you can go for it, Beck. So the things to start with is, what can you do before the 30th of June to save tax? Everybody asks the same question. I don't want to pay any tax. Don't want to give Albo any more money than I have to. The first thing we need to just look at is how much profit you've actually made, and then what you estimate your profit to be before 30th of June. Are you going to make more profit? Are you going to make a loss? Are you going to make break even? Because then we've got our starting point. At the end of the day, if you are paying tax, it's a good thing. You've actually made money. So we do want to pay some sort of tax. Just how much do we want to pay? So just make sure that we are making some type of profit. The second thing you need to understand is whether you are on cash or whether you're on accruals basis for tax purposes. Now, it could be different for GST. So don't look at your GST return. You actually need to look at your tax return. So in layman's terms, cash, obviously, you get the money in, you pay the money out. That's how we record your accounts for tax purposes. If it's on accruals, then it's when you get the invoice in or when you send the invoice out. So that could have a big bearing on your tax position. If you send that invoice out to the customer, then you're going to pay tax on it. If you get a big supplier invoice in, then you can claim that as a tax deduction. So it's understanding cash versus accruals and what that impact back is onto, again, your accounts.
Bronwyn, can I ask a question?
Yeah.
Do you have a choice in between cash or accruals, and is there a preference?
You do have a choice up to, I think it's $50 million, where you don't have a choice. Don't quote me on that, actually. I think it's 10 million that I've just said it out of my head. Yes. GST, it's 2 million. So you've just got to check. You can. So the other, I'm going to say that all again. It comes down to your books of records as well. So in the old days, everybody used to operate out of a shoebox. So therefore, you would have, it was when you actually physically did those sort of things. When you're on a computer system, you're more likely to be on an accrual system because you're already recording those invoices. Yeah. So
in other words, if you say you're using a Xero or a MYOB or whatever, it's when you send the invoice.
Correct.
That's the time that it's taxed effectively.
Correct.
Yeah.
So ignore everything I said about turnover. It's about your accounting package. And Diana's probably sitting there going, yes, Bronwyn, that's right. Is that cool? Make sense?
Yeah, no. It's just that, we often hear you can go one or the other, but in reality, probably most are accruals anyway, because most people would have some form of software.
Correct. Yeah. The next thing is just home office expenses. A lot of people ask, well, what can I claim at home? The ATO actually have a rate you can claim in your home office. So you can use that. So how many hours you work. So if it's 10 hours a week at home, and you can multiply by that rate. The ruling does talk about all the things that's included in that rate. So you can't then go and claim other expenses. That's the rate, and that's an all-inclusive value. So you can do it that way per the ATO. So if you just want it to be simple, you do need to keep a bit of a logbook as to how many hours you have been working at home. Your other option is you can do actual expenses. So your actual telephone, your actual internet, anything else that is in your home office. Purchasing of computers, your monitors, your stationery, all of that sort of stuff can be claimed. So you do have two options, the ATO rate, or you can claim it based upon actual usage. But again, you just need to be able to justify that with the ATO as to how you've come to say, okay, I'm going to claim 40% of my internet as a home office expense. Yeah, cool.
Yes, I read an article this morning about you can't claim watching Bridgerton on Netflix as a home office expense.
Yeah, unfortunately, no.
However, though, in for example, my husband's case, he works for a sporting organisation for cricket, so he can claim a portion of that because he is required to be watching cricket as part of his job. So there's obviously different rules.
Yeah, and how do you justify that is the hard part in an ATO audit. So, yeah, just think about it before you maybe claim that. The next thing is super. Again, lots of clients ask about super. So you've obviously got your concessional contributions, which is the contributions you can claim a tax deduction for. Included in those superannuation, those concessional contributions is also your super guarantee. So if you're employed, so you might run a business, but you also may have employment. So your employer is probably paying super on your behalf. So that's super. Plus what you would like to contribute personally, you can put up to $27,500 into super to claim a tax deduction. So, if you had a spare $10,000, for example, and you want to put into super, you could do that, and it's within the caps, then that would be a tax deduction and would save on how much tax you would pay against your other income that you've earned for the year. The other thing that the ATO or the government has introduced is carry forward balances. So if you don't have enough money in super, the ATO is saying that you can actually bring forward the past of where you haven't been putting in enough super or up to the caps in super, and you can put that money into super. So I had a client the other day who could actually put $110,000 into super because she hadn't been putting enough in and claim that as a tax deduction this year. So you need to look, go to your accountant and just get them to confirm what your carry forward balance is. And if that's an opportunity to put more money into super, if that's what you wish, you can do that as well. If you're in a situation where, you are the main breadwinner and your spouse is not, and they are not don't have much in super or much in income, then you can actually make a spousal contribution as well and get a rebate for how much you put into super. It's not a lot of money, but if that's an opportunity, you could do that as well. If you're in business, the question is, when do you actually pay the super for your employees? So it's normally due the 28th of the month following the quarter end. If you wanted to claim a tax deduction this year, though, you could put the money into super now for the employees and get that tax deduction now, and that will help reduce your profit. If you don't pay it until the 28th of July, then you won't get the tax deduction until next year. So the word of warning is it's got to clear the clearinghouse in time before 30th of June. So if you're on Xero, as an example, it has to be with Xero's clearinghouse by the 15th of June. If it's after that, they're not going to guarantee that you're going to be able to put money, they're going to clear the funds in time to claim the tax deduction. Okay, so super can be from a personal perspective, but from a business perspective, to make it tax effective right now is to pay the super right now. Cool. The next one is logbooks. So the ATO is rampant at the moment in regards to fringe benefits tax. And for those people, especially that have a luxury car, which is over 70 grand, is a luxury car. So they're matching up records in the background and looking at who's got cars in their trading entities, and are they lodging FBT returns. So a big thing at the moment is to make sure you've got your logbooks in place. They only have to be for 12 weeks and they last 5 years unless you change your job or your location. So please make sure that you've got those logbooks in place, and then also make sure that you are lodging fringe benefits tax returns if you're a company or a trust, because what that does is puts a line in the sand with the ATO, and they can't actually go back and do an audit on fringe benefits greater than 3 years. If you don't lodge an FBT return, then it's an unlimited timeline for them to go back and have a look. And you're not going to probably have the records if they have to go back. So just logbooks are really important for any cars that you've got within your businesses. So an option to reduce your tax is to prepay expenses. So rents, insurances, anything like that you could pay up to 12 months in advance, you can claim as a tax deduction this financial year. So if you've got lumpy profit, so you've got a really big profit this year, but next year you're in, because you've had a really good contract, but next year you're not going to have that contract, you could go and prepay your rent for 12 months, claim that this year so your tax is lower, and then next year when your income is not going to be as high, then it's going to even itself out anyway. So any opportunity to prepay expenses, you can prepay interest as well if you've got loans in your business. They're all ways just to reduce your profitability down. The other way to do it is to delay your income. So this was when I was talking about the accruals method. So instead of invoicing on the 30th of June, invoice on the 1st of July. So then all that income gets pushed into the next financial year. Again, you're going to look at your lumpiness. Does it work? Does that not work? On my next slide, I'm going to come back to that because that can have a big bearing on your business though, moving forward. But a lot of clients delay their income by that one day to make a big difference. Just remember this year, the 28th of June is the Friday. And the 1st of July is the Monday. So just in terms of your timing, how you can structure your invoicing. The next one is work in progress versus invoicing. So obviously when you invoice, you're going to pay tax on it. In certain circumstances, if we classify it as work in progress, you don't pay tax on that for tax purposes. So that can be a way to make your profit and loss look good, but without paying the tax. So for builders, for example, we would put in place some work in progress because they technically can't bill their work until the progress payment is due. But then we need to make it stack up for the QBCC or for financing or whatever the case may be. So WIP can be used in a lot of businesses. Does depend upon your business, but WIP can be a way of making it look good but without paying the tax in this financial year. The next one is purchasing of assets. So it's not, or up until the 30th of June, at this point, if you buy an asset that's less than $20,000, you can claim a tax deduction for it instantly. If it's $1 over, then you can't claim it. So a lot of people go, I'll just go and buy a car. Well, a majority of cars are going to be over $20,000. So if you've got computers, if you've got photocopiers, desks, all that sort of stuff, they're likely to be under 20 grand. So that's a way of getting a straight tax deduction in this financial year and just saving on that tax. In the budget, they announced that it was to continue for another year. That's not legislated yet, though. So we're just watch and see for that legislation to occur.
And just a question on that, Bronwyn, the difference or how it used to be was that you couldn't claim it as an instant write-off, but you could depreciate it over time.
Yeah, so if you're, correct. So and that's the case for anything over 20,000. So if you purchase it under normal depreciation rules and you're a small business, then you get a 15% tax deduction in year one and 30% thereafter. So it's a big difference getting 20,000 straight away versus 15,000 of that item. Yeah.
Great.
For those businesses that have stock, important to obviously do your stock take, because what that's going to show is where, number one, where your levels are, but also is there anything that can be written off? Is there any obsolete stock? because if we can write that stock off, then that comes off your profit as well. So that's a quick way to reduce your profit. Obviously, we don't want to have obsolete stock. We'd like to sell it. But if you can't, if there's been a new product released or whatever, then 30 June is a perfect time to write that off and not be paying tax on stuff that it's worthless. Yeah. The other thing to do is then to review your customers that owe you money and write off any bad debts. Again, perfect opportunity, 30 June, clean up your balance sheet. You have to make sure that it's definitely not collectible to be able to write it off. So normally they're in liquidation and you've got your creditors report saying that there's nothing there, or they've closed down, or, they've done the runner or whatever, then as long as you've got that evidence, then you can write those things off as bad debts and again pay no tax on those customer invoices. And the last idea is just around, depending upon once you do all of those number 1 to 11s, you may find that those PAYG installments that you're paying, so your quarterly taxes you're paying in advance for the ATO, you may be able to vary it down because you may not be making the profit that the taxman thought you were going to make. They base it on the year before. So if the year before was a really good year and this year is not such a great year, then, you've been paying probably too much tax along the way. So that's an opportunity for you to vary those installments down. The proviso is, though, if you vary it down and you're wrong, as in you should have paid those installments, the ATO can penalise you. So you've just got to bear that in mind before you do any variations on that. So with all that in mind, so we've reduced our profit, we've saved on tax, but what's the pitfalls of doing that? So the number one pitfall is, what's the impact of it on your cash flow? So if you delay those invoices by 1 day, does that impact then when you're going to receive that customer money in? So some customers may only pay 30 days end of month, for example. So if you did an invoice on the 1st of July, they're not going to pay you till the 31st of August. Compared to if you did on the 30th of June, you're going to get paid on the 31st of July. So it's what's that impact? If you go and prepay a heap of stuff or you buy a heap of equipment, how does that affect your cash flow again for the coming period? Is that going to put a hole in you and therefore you're going to, just create too much issue for yourself? So impact on cash flow is really important. The second thing is around, a lot of the strategies that I've talked about are deferring tax. So the delaying the invoices, prepaying expenses, etc. They're reducing my profit this year, but I'm only going to push it forward to next year. So just need to make sure that when we're aware that that's fine if we're going to reduce it now, but next year, what's that impact? And therefore, are we just kicking the can down the road? So at what point are you going to pay some sort of tax in there? The next one, which we're seeing a lot of, is just the impact on any financing in the coming year. So if you're going to go and borrow money, and your profitability is way lower, how is the bank going to like that? Is that going to impact on what loans you want to take out? Is that going to impact the loans you've currently got? That's where the WIP can come into play, so that work in progress. So we can make the P&L look really good with work in progress for the banks. But again, you need to just talk to your accountant and just make sure that will stack, and your finance broker or your bank, especially if you know you're about to take a heap of finance out. And then the last one is which is very similar to the financing, just the impact on tenders. So again, is that going to, if you have to provide financials for your tenders, then if you're looking not so great, how does that work? So that's the pitfalls. The next thing is just a really quick thing, because then it's over to Dianna. It's just important dates that you guys can just be aware of. If you operate out of a company or a trust, So company, you need to have your dividend minutes done by 30th of June. You need to clean up all your loan accounts. Major ATO target is on those loans. You might have heard of them being called Division 7A. So it's whenever you guys take money out of the company and use it for your personal purposes. The ATO doesn't like that. So how can we clean a lot of those up before 30th of June? Same with trust, cleaning up those loan accounts and making sure they're okay. Having your trust distribution minutes done before 30th of June. If you don't have trust minutes done up, then technically the profit from the trust has to go to the default beneficiaries, and that may not be tax effective for you. And then the other ATO target is around that paying out profits to beneficiaries, but then the cash doesn't flow. So making sure all of those beneficiaries' entitlements are paid out and cleaned up. So your accountant should be doing all these things for you at this point in time and making sure it's all beautiful. If they're not, please just go and have a conversation with them. Then whether you're a sole trader, partnership, company or trust, if you've got employees, your STP annual lodgement is due in July, work cover is due, your payroll tax is due, and then your June BAS is due in July or August as well. So just making sure you maintain those dates with the ATO, because again, with everything just being online now, they can see everything. So just making sure that's done. And then the next slide is just some resources. So Beck's going to send out this little PowerPoint so you can go back and have a look. But there's just some articles we've written just in regards to looking at your business and how to save tax, etc. So I'll stop. If there's any questions,
Bron.
that's all right. Happy. Otherwise, Dianna can go for it.
Just check in if anyone has any urgent questions that they wanted to ask Bronwyn. We will have some time at the end to circle back to both Bronwyn and Dianna. Is there anything that you wanted to just clarify from Bronwyn's presentation? All good? Nikki, yeah,
yep.
Go for it.
Yeah. Can I just check, Bronwyn, so the POIG instalments and changing that percentage, like how much can you be out before they consider it penalties, like if you vary it?
Well, to be honest, in 30 years of practice, I haven't seen it.
So you could vary it.
But it's there. It's in the legislation. So, I mean, Dianna, I don't know whether you've seen any.
Never.
Yeah, so I don't know, but I'd rather tell you than all of a sudden ATO or the government's kind of broke. So God knows what they'll do next.
Okay. Thank you.
But it's upon you. It's incumbent upon you to make that variation, isn't it? It's not like they're going to go, hey, we want you to pay it quarterly or annually now. It's up to you to alter those installments based on the previous year and your expectations for the year ahead.
Yeah, so right? The ATO will tell you what they think. They're going to think that you're doing exactly the same, and then it's up to you. If they say, okay, your installment's going to be 10 grand, and then your profit is going to be way more than that, and you should be paying 20, doesn't matter. But it's when you go down is the issue.
Right.
Got it.
Okay.
Yeah.
Thanks,
Yeah,
Bron.
they don't care if you overpay it.
Of course not.
Yeah, exactly.
Of course not.
They're now paying interest on overpayment. That's a first for this year. So if you do overpay your tax, they're actually going to pay you some interest, whereas they normally only ever hit you if you owed tax and you had to pay interest. So it's a win.
Absolutely.
You have to pay
All
tax.
Right, we might
pay you though.
Oh yeah. Sorry, they pay you interest, then you have to pay tax on that, do you?
Correct.
Oh God. Let's make it a lot more complicated, huh? All right, Dianna, we might hand over to you.
Okay. Hi, everyone. I also have been an accountant for 30-something years, a little remember to wear my CPA pin today. And I work out in rural areas, so lots of small businesses and lots of agribusiness, and specialise in farm succession planning all over the country. So I've got my regular accounting practice, and then we've got the specialist work as well, which is why we're travelling and down in Gippsland at the moment. So normally when I teach, I speak at a lot of seminars and things like that. I unpack everything in diagrams because I think that's a lot more palatable. So she says, and went to open the window that was here before and is not here now. Give me a second. How many times did we just practice this?
We did, and it worked like a charm.
Screen sharing, window. All right, just give me a second, guys, while I do that. So a couple of things while I'm just getting that organised is just to further with the comments that Bronwyn made. There are a few things, I guess, additional to that will be relevant to farming or agribusiness. So as well as inputting money into superannuation for a tax deduction, one of the things that we do in rural businesses are farm management deposits. So that's also a tax deduction as long as they stay in there for 12 months. And then when you take them out in whole or in part, they become assessable income. So again, as Bronwyn was saying, it's really important that you work with your accountant to see where are we tracking for this year to date, and then what are the options. A couple of other things that just have that slant on agribusiness, as Bronwyn made reference to prepayments, there's an option in ag business called Ag Pay, where some suppliers have that as an offer where you can order your fertilizers or sprays or seeds or whatever now and get the deduction now, but they won't be payable until December. So it also helps with that cash flow impact because you are getting the tax deduction, but you are not paying it till December. Bearing in mind, very much as Bronwyn said, have an idea of what your seasons are like, of that pattern, that lumpy pattern as you referred to, because we don't want to bring forward all the deductions and then we have a bumper season next year. You know, it's a matter of very much, even some of our 2023 work, we're only just finishing now because we were waiting to see what this season was shaping up like as to what we wanted to land in the different years. So obviously there's lots of variables in ag business. And another thing that you've got in ag business is a primary production averaging, which means that when you have primary production income, you get an averaging provision in your tax estimate. So when you've got higher years, it'll be averaged up to the previous 4, so over a 5-year period. And the years that you've got lower, it will average out because, again, it's so volatile and potentially disparate. So
I've always been in awe of farmers being able to manage things seasons and seasons ahead. But now I think I'm in awe of the farmer's accountant for being able to juggle all of those particular, thought processes and different requirements, because that would have to be, we know how seasonal agribusiness is.
Yeah.
But to try and flatten that out in a way that cash flow is available when you need it, and you can take advantages of whatever schemes may come along, which they sometimes do in difficult conditions. Wow, what a balancing act.
It is. There's a lot of rules, and as well as all the normal accounting rules, there are a whole suite of the unique ones around that. So really encouraging anyone in agribusiness to be working with your accountant at this time of the year quite closely, as well as any other small business, of course.
So just for those of you who are seeing, you'll see Dianna's whiteboard there on screen. If you don't, just move your cursor to the toggle tile view, which is one of the little 4 squares down the bottom, and it will bring that view up in a large screen for you.
Okay, so generally when I do any presentations, I just unpack with diagrams as well as, and Bronwyn had the PowerPoint, so I figured I didn't need to have the same things. So one of the things I wanted to mention is people often don't realise that there's a team Most people know that they have an accountant and that they go to the accountant around tax work. But a generation ago, there was a lot more scope of what an accountant or a bank manager could teach people about and converse about. The problem now is that the licensing has got more and more and more strict. It started in year 2000 and then there's been a few overhauls and new tranches of rules. So the licensing is really narrow. And what I see in small business is people fall through the cracks because they don't know what they don't know, and they haven't realised that each particular professional in their team now can only speak to their part. So they'll have an accountant probably. They may or may not have a financial planner or even realise why they need one or where one fits. So accountants tend to look at what's happened historically and do the tax reporting, as well as at this time of year very much proactively tax planning for the year ahead. Financial planners very much are future. So they're the wealth creation, the superannuation, maybe any age pension or aged care or Centrelink provisions, investments and so forth. And there's a really, really strict firewall in between the licensing. And so when Bronwyn makes reference to superannuation, which is a very integral part of the conversation, regardless of age, stage or your financial situation, because you just vary the numbers, whether it's $100 or $10,000, it's important to know where that is. But accountants are limited in the advice that they can give there. So I've got a range of qualifications because to me, this should be one conversation. So people will have a bank manager or a mortgage broker if they can find a bank manager that stands still, chain them to something. They'll have an insurance rep. They'll have a solicitor. And everyone has the butcher or the bloke at the footy or the bloke at the pub. And the small business owner stands in the middle and everybody's telling them something different depending on their own slant and their own perspective. And this person in the middle is going, who the heck do I listen to? Because it is very common that the advice they get from even one of the professionals, not just the bloke at the pub, might be counter to something else. So for instance, it is not unusual for people to set up loans the way the bank tells them. And then when they come to us as the accountant, they won't be able to claim the interest because it's been set up in the wrong structure or in the wrong, against the wrong asset, in the wrong order, things like that. So it's really important that you get some advice as an holistic picture in this. We do a lot of estate planning, we do a lot of wills, we do a lot of legal work, we do a lot of asset protection, much more as a strategic plan, not so much an estate plan, depending on ages and stages, but very much to protect the family and the assets, whether it's a farm or anything else. So of course, then we need to have the conversation where we're bringing in the legal side, and I actually have our solicitor that travels with me here at the moment. We do all the travelling all over Australia together with this work, but it's important to get that lined up with, for instance, the financial side. And again, we see a lot of problems with this. So areas where this falls down will be things like capital gains tax. So capital gains tax is levied on contract date, not on settlement date. So that's a big issue at this time of the year if people are selling something that becomes a capital gains taxable asset, but they think it doesn't count until next year. If you've got the contract, you really need to be having a conversation with your accountant really quickly. This is where those superannuation provisions, and there are some special ones around active assets and capital gains tax, too long to go into here, but very, very much needing a conversation with your own advisor on how you might be able to mitigate or manage the capital gains tax issue on assets. Another one that Bronwyn made reference to is with terms of paying out company dividends. We've got an issue that I've been involved with a little bit with some clients in Victoria where they've stopped forestry. So there's quasi payout packages, as in there's lots of qualifiers for that. And one of them is a redundancy, but again, with qualifiers. But if you're paying out dividends and there's a redundancy, there's lots of tax implications. So again, it's not just a number crunching and or a legal exercise. It's very much been both together. Is what are the legalities? How does that affect the numbers, and vice versa? So this tax entity structuring that, and Bronwyn just also went over for everyone's benefit, what you can do in a sole trader, a trust and so forth. But this is also really the time to be looking at your progress in your business journey to see, are we growing? Do we need to revisit whether a sole trader or a partnership, for instance, is still the right structure for us? Because it's not unusual for clients to come along that perhaps should have been changed to maybe a company structure or something some time ago, but they've just ticked along with what they were already in, and therefore they don't have the asset protection and or the tax mitigation or the strategic planning that a better entity would give them more a better fit for. So we need to have our team, and it's important that we've got reference to who gives what advice. And again, your accountant, I think, is the best person to be this, the outside circle there in that holistic person to say, here are the other things you should consider, and here is the person that you should go and talk to about that if it was outside of our reference in our professional realm. So if we clear all of that, or I don't know where there's a clear page here. I'm going to have to backtrack. Sorry, just practicing with this. Blank page. There we go. So we've got our team, and we need to be mindful of where that team fits. So a couple of things to just look at with who fits in which box there. And one is superannuation. And I just wanted to give a quick rundown because in my experience, this is something that nobody ever explains to us, and most people go through life not understanding it. But super is likely to be the biggest asset we amass, possibly second to our house, but we give it no attention and we really don't understand it. In basic terms, at one end of the scale, we've got what are called industry funds. And so when Bronwyn's talking about putting money into super, and this is a strategy that we use for our clients, with my financial planning hat, so, disclaimer, 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 and this is all general information, but we need to make sure that we're not putting our money somewhere that's just evaporating. So industry funds are kind of a one size fits all. So these are things like the state super funds, the Vic Super, Host Plus, CBUS, Australian Super, all those sorts of ones, where they're governed by a team. The money goes in, it's usually put into sort of a one size fits all investment. So they might own a couple of big commercial buildings, number 70 Collins Street, and it's worth $50 million or whatever. They have insurances in super, which is an important thing to note. So life insurance, income protection, and permanent or total disability and trauma. So these are things that also there should be some questions being asked. Even if you ask your accountant what they are, it's a financial planner that would set them up, but they're worth having. So we have insurances, we have investments, and we have fees. And in these industry funds, we don't have much say over any of those. We just money in, money out, and then so we all get our distribution, and there's not a lot of choice around that. At the other end of the scale, most people will have heard of self-managed super funds. And in these, we get to choose the investments, we get to choose the insurance, and therefore we can manage the fees. But the main thing that you would ever have a self-managed super fund for is because it can own direct property. So a lot of small business shops or warehouses or sheds or industrial sheds are probably owned by someone's self-managed super fund. However, there is one in the middle, and these are called retail funds, and these are what financial planners look after. And the reason that you have a financial planner is because these ones, we can choose the investments, we can choose the insurance, we can manage the fees. They're a lot more customised and often a lot more user-friendly and cost-efficient than the industry funds. a lot less clunky than a self-managed super fund. And unless you are going to have direct property, you don't need a self-managed super fund. Often, in my experience, the industry funds are a good fit until the age of around mid-40s, perhaps. And then once we've started to have a few accidents, we've broken our leg, we've done a few things, the insurance, we don't realise, but the insurance might have become invalid. And the investments might be a little bit too robust or a little bit too on that risky side for our age and stage in life. And this is where it would be worth just having a chat with someone. It's not about a sales pitch, but just having a look at, where is my super? Is it in the right place for my age and stage and my circumstances? Or is it time to look at rolling this over? A quick disclaimer here, do not do this yourself, because you may have an insurance policy in there that is absolutely gold that you won't be able to get again. So it's always really important that this is done by someone who knows what the steps are and what they've researched before any steps are taken. So we've got a couple of things there that are just to bear in mind around super. As Bronwyn said, we've got this, I think, good initiative with the carry forward balances, so we can put in more than just this year's limit if we have been short in what we've put in. A couple of the crunching numbers there, and again, go and speak with your accountant, but there's some qualifiers on that in terms of the total superannuation balance. You can only use that if you're under 500,000 at certain dates. And there's also a number of concessions around capital gains tax and super and active assets, things called a downsizer. There's deductible or non-deductible contributions. There's a number of ways that you can manage super, and it's important that we get advice on not only how we contribute it, but also the order that things go into those funds. And our ages have a bearing on that. So there's certain rules at certain times of our life. 60, 65 and 75 is a cutoff with super, but we need to be very mindful of dates and timeframes and not just assume that we can go ahead and do things. So we find another blank page. The other thing that I wanted to mention a little bit, just very quickly on that legal side, is to pay some attention to how you are set up with wills, powers of attorney, testamentary trust. We use things like a deed of family arrangement, vendor finance agreements to allow intergenerational succession planning. There's a lot of strict rules around state stamp duty, so that's not one that accountants or will be telling you, because it's a legal aspect. So anyone that is in that rural space particularly, it's super important that you get advice on this and not just assume that you're exempt, because you're only exempt from that stamp duty on family farm transfers if you've got things written up properly. If not, it's about $1 million in stamp duty that is the penalty for not getting it right. Other things in that estate planning space for anyone is just with your superannuation, there's a thing called a binding death nomination. What people don't realise is that in our super, if we don't have a binding death nomination, the super reverts through to our estate. Now, estates can be contested, so depending on your circumstances as to whether that's a good fit. But the other thing is that if our super goes to what's called a non-dependent beneficiary, so someone who is not our dependent, not a small child or our spouse, or perhaps someone with a disability, it can be taxed at up to 30%. So often as people get older and perhaps their spouse passes away, it's time to have a look at how that super is structured to see whether it's still in the right place in terms of how it might come out. Now, the other thing I just wanted to do a really quick diagram is about mindset. And I know that sounds really weird, but I work very much in the space of creating the mindset to grow your business, to grow your wealth, to grow your holistic wellness. So we have to picture where we want to go, the same as what we were talking about with tax planning, the same as if we were building a house or taking a trip. What happens is people stand here today and they look back at the past. So the past, present and future. They look back at the past and we keep doing the same thing. We go round and round, around, and we wonder why we get the same result in any facet of life. And we end up with this sort of tangled mess here that we think, oh, now I've made a mistake. We get a bit obsessed. We just keep focusing on that and doing the same thing. With life, with business, with anything, we need to cut that, face forward. We need to build a picture that we want to create, leap above all of the obstacles, real or perceived. I'm too old, I'm too young, I don't have the right education, my mother won't like it, who's going to feed the dog? And then come back to today after we've got this picture and then just take one step at a time towards that. Because what I see in business all the time, and I work in very varied scale and scope and size and industries in business, is they're trying to put the pieces together one brick at a time at this end, but there is no picture. And it's much easier then to keep falling back into all these old patterns and beliefs and trips and traps than to hold firm the vision that we're working towards and then making the decisions, taking the steps accordingly. So I know that sounds a bit out there, but it's a critical part of building a business or any part of our life, whether it's a health goal or education or a holiday. But our subconscious works to match our picture of ourselves and our beliefs about ourselves. So it's important that we build a picture that is what we want, not keep talking about or obsessing or going back into this old stuff that is not what we want. So this is where vision boards, goals, business plans, task lists, and so on, and including things like cash flows and budgets, are super critical, because then we have a direction. We've got like an instruction sheet. It's like having a map, and we know where we want to go. So it's important that we have those as part of our business plan. And new financial year is always a really good time to have a look at what's working, what's not working, what did I achieve, what might I want to achieve over the next financial year, and then building that into all the things that Bron was talking about, where it becomes part of your mapping out for the next year off the back of where we're at for this year. So that's probably enough. We've dropped a fair few things on you in all of that. My details will be shared in the information from today as well, so I'm always happy to have a phone chat with someone and just kind of perhaps give an idea of questions to ask, as well as sharing some resources, as well as Bronwyn's there. So anything that we can do to help, please don't hesitate to ask.
Thanks, Dianna. I think that was a great way to round off the session, because I think, you know, it's fair to say for a lot of us who don't feel entirely comfortable in the world of accounting and numbers and financials, it's a case of doing exactly what you said, focusing on the past and what we did wrong, as opposed to why we need to change and what we need to change in order to create whatever it is that we're heading towards. So thanks for that. I think that was a nice way to put the importance of at least a level of understanding of our financial position and knowing who to talk to. And I think your explanation about a team and who to ask, you know, what's the difference between financial planner, wealth planner, accountant, etc., etc. I think there's some really useful information there for us to just start to think in that bigger picture. But I might hand over to our guests for any questions that they may have, either of Bronwyn or Dianna, from today's session.
Are they still awake? Just checking.
Sandra, I might invite you, because I could see your ears sort of prick up when Dianna got onto the bigger picture piece there.
I just want to say thanks for that. It's just great to get the whole sort of, you know, bigger picture about all these issues, and certainly it's jogged my thoughts around a couple of things. I've circled some, like, you know, pay super. Can I actually ask Bronwyn, just on that pay super from profits before, you know, 14th of this month, am I just paying it in a lump sum out of the, you know, out of profit into my super fund, without having to go through like attached to a salary. I mean, I just pay as a lump sum.
Bronwyn, you're on mute there.
So you can make a personal contribution as well. So that's fine. So when you lodge it, though, through to your superannuation fund, you have to notify them that you're going to make a tax deduction for that super. And then you'll get a notification back saying yes, and then you give that to your accountant to make sure that they can claim it in your tax return personally. So I don't know your structure, Sandra, whether you're a company or a trust or a sole trader. There might be just some play in the background for you to claim that deduction easily if you've pulled it out of a company, for example, but the net result is you can claim that as a deduction.
Yeah, thank you. I do recall that.
Can I just add to that the important part is with your super fund that sometimes when you put it in, there's a BPay and a reference number. There's often a different reference number if it goes in as a personal contribution to when it's a super guarantee or employer contribution. And then, as Bronwyn said, there's a form that you'll either get from your super fund or your accountant. We all have the generic ones we send out where you've got to nominate that it's a deduction and make sure that you don't lodge your tax return before you've got confirmation back from them. That notice of intent to claim doesn't have to be to them before 30th of June, just the payment does, as Bronwyn said. But the notice of intent to claim certainly has to be in and processed by them before you lodge your tax return, or you won't get that deduction.
But you want to do it also earlier rather than later, because if they've already done their tax return, to try and change it from being non-deductible to deductible in there, it's a nightmare. So just make sure you do it at the latest July.
Thank you. That's great. It's complicated, hey?
Yeah.
It's kind of reverse engineering a lot of the time. Yes, you've just got to know what all the questions are before you start.
Mm-hmm. Okay, great.
Any further questions from our panel? If not, I will wrap up today's session. Thank you so much to Bronwyn and to Dianna. It is always one of those topics that, there's a lot of detail in there, but I think as business owners, it's incumbent upon us to become educated in some of these areas that may not be our core business, but ultimately they are core to our business. So it's important for us to know the types of questions and areas and options out there, and then obviously be able to, fortunately, be in the position to be able to call on people like Bronwyn and Dianna for a bit more clarification. So out of today's session, we'll share with you the recording. So if there's some bits that you want to listen back to again, we'll also share the presentations, Bronwyn's presentation, and contact links for both Dianna and Bronwyn. Don't forget our Women's Network magazine and blogs. Both Dianna and Bronwyn are regular contributors to both of those on various articles. So you could search them by name, particularly on our blog, and find articles of interest. So thank you, everyone, for a tough session, I'd have to say. Like, they're always big things. There's lots of planning and thought and things to sort of think about in future, but they're really important for business, particularly in the current times. So good luck with the incoming 30th of June deadline, and especially good luck to Bronwyn and Dianna for the big whack of work that's about to come their way. So thank you all, and enjoy the rest of your day.
Thank you.
Thank you.